Every month, millions of people invest through SIP. But almost nobody knows where their money actually goes after pressing that invest button. Let's follow just $100 and see exactly what happens to it. Not the simplified version. The real journey. Most investors imagine their money sitting somewhere inside a giant vault waiting to grow. But that's not what happens. The moment your SIP is processed, your money gets assigned a job. Actually, hundreds of jobs. Your money is used to buy tiny pieces of real companies. Not symbols. Not numbers. Actual businesses. A small portion may buy part of Apple. Another portion may buy Microsoft. Another may buy Amazon. Think like an engineer. Would you trust a single machine to build an entire city? Probably not. Instead, you'd deploy thousands of machines across hundreds of locations. That's exactly what a diversified SIP does. Between you and those companies stands an investment team, constantly managing the system. Here's the surprising part. The fund manager usually isn't holding your cash. They're holding company ownership on your behalf. But ownership alone isn't why SIP investing becomes powerful over time. Something much more important is happening. Month 1. You invest $100. Simple. Nothing exciting yet. Then next month, another $100 enters the system, whether markets are up or down. Now imagine, markets suddenly crash. Most people panic. But your SIP behaves differently. Because when prices fall, the same $100 quietly buys more ownership than before. And this changes everything. Imagine your favorite company suddenly goes on sale. Most shoppers would celebrate. Investors often do the exact opposite. When prices drop, your SIP doesn't buy less. It buys more pieces of the same companies. Think of building a bridge. If steel suddenly becomes cheaper, your budget buys more steel, not less. Your SIP follows the same logic. It quietly accumulates more building materials for your future wealth machine. 1 month isn't impressive, but what happens after 10 years of repeating this process? This is where investing stops behaving like saving and starts behaving like physics. Because the companies you own generate profits, and many of those profits get reinvested to generate even more profits. It's like building a machine that starts building new machines by itself. In the beginning, growth feels slow, almost disappointingly slow. Then something interesting happens. The system begins helping itself grow. Now your earlier investments are generating growth alongside your new investments. Remember those tiny financial engineers from earlier? By now, there are thousands of them working for you. If compounding is so powerful, why doesn't everyone become wealthy from investing? Because there's one thing more dangerous than market crashes: human emotions. Right when markets become scary, many investors stop investing, and that's usually when future opportunities are the biggest. Every market crash in history felt permanent while it was happening. But eventually, businesses adapted, economies recovered, and markets moved forward. And when recovery begins, something interesting happens. The investors who kept buying during the storm suddenly own much more of the rebuilding. Because those lower prices allowed the exact same $100 to accumulate more shares than before. Of course, operating this entire investment machine isn't completely free. There's a small maintenance cost behind the scenes. Fund managers, research teams, technology systems, and administration all require resources. That's what the expense ratio pays for. This is why a SIP isn't really a savings account. Savings store money. Ownership grows with businesses. Every month, your SIP quietly recruits more workers into your financial workforce. Workers that never sleep, never complain, and never ask for a raise. So where does your SIP money actually go? Not into a vault. Not into a magic box. It goes into ownership. Ownership in companies building phones, software, medicines, energy systems, factories, and technologies. Shaping the future. The real secret of SIP investing isn't finding the perfect moment. It's staying invested long enough for ownership to do its job. Because in investing, time is usually more powerful than timing. If you knew your money was buying pieces of the future every month, would you really want to stop halfway? Because wealth isn't built in a day. It's built one contribution at a time. Whether you notice it today or not, your SIP is already working behind the scenes. The question was never where your SIP money goes. The real question is whether you'll give it enough time to grow.